Hello, and welcome to the Invest with Carl podcast. I'm Jamie Uppenberg, your host and a member of the Carl team. I've been with you guys so many times now. Hello. We are chatting today with the Milligan brothers, Drew and Quinn Milligan from the Woodworth Contrarian Fund. We are going to ask them the usual questions about the fund, what makes it successful, some fund history, and what's important if you're taking a look at this to invest. We are Carl, digitally offering unique investment opportunities, usually hedge funds, with packaged and data-driven delivery to accredited investors. The Woodworth Contrarian Fund is an upcoming investment opportunity available. Today, we have Quinn Milligan as a graduate of Oregon State University, and Drew Milligan was a Series 7 licensed stockbroker. Quinn and Drew Milligan are brothers, and they are lifelong Oregonians and longtime portfolio managers who were trained in contrarian investing at their father's stock brokerage firm from a young age. So they have, as many of our fund managers have been doing this a while. In 2016, Drew and Quinn started the Contrarian Value-Based Hedge Fund with a core foundation of partners to invest for the long term. And most of those partners are still with the fund to this day. So they've been doing pretty well. And as the brothers like to say, when the market counts a company down and out, they take a second look. So let's find out why. Hi, Drew. Hi, Quinn. How are you doing today?
Doing great. How about yourself, Jamie?
I'm
Good to be here,
good.
Jamie.
Yeah. It's a new year. It's 2025. So we're all doing good. You guys are getting ready to launch this. So let's kick it off. First of all, tell us what made the Woodworth Contrarian Fund or strategy successful so far. Really, why would you keep it in your own portfolio?
So the contrarian investment philosophy is, for a lot of our partners, it's a diversification that they really can't find anywhere else. We've been successful because it's so adaptable. We look for value where other people have ignored it, forgotten it, misunderstood it. And so inherently, we're not, if times change, our strategy still makes sense. And in the long run, we outperform. So, that always helps.
Companies in transition.
Companies in transition. I'm going to ask a couple of questions about that, but I'll start first with a little history. How long has Woodworth been running?
About 8 years since we technically started January 2017.
Okay.
Formed late 2016, fully funded January 2017.
Oh, great. Okay. And obviously you've been doing well. COVID didn't have you guys kind of weathered I know some did very well, but
Yeah, we actually did very well.
Funny story about that. We were hit in March of 2020, one of our worst months on record. And then we were kind of looking at each other thinking, well, okay, either the world is going to end or there's a lot of really good buying opportunities. And well, the thing is, if the world ends,
You're kind of screwed anyways.
yeah,
You got the problem.
it wouldn't have mattered.
The saying in a nutshell is you always buy missiles in the air, because if the missiles hit, your dollar's worthless anyway. So you might as well buy.
So we had a fantastic month, the month right after that, and had a great year. And so, it all worked out.
Okay. This is another interesting point on the fund, because in times where the market's overvalued, we tend to be a little bit risk off, just because there are fewer values in the market, which tends to mean we have a little bit more dry powder when the market does pull back, which is in part the reason why we tend to outperform when the market's down.
Okay. Very interesting. Obviously, you've been running a while. They can look at your track record. They can look at your data. If we're taking a look at your fund. Help me understand. Obviously, you guys are taking a look, you say, at funds or I should say investments that others are passing up. What is it about how you look, and how can you better discern which ones to invest in and which ones to still pass on than someone else?
That's a great question. And, I think one of the important things to understand about how we think, we're stock pickers, and we don't know anything that is not publicly available. If somebody tells you that they know something you don't, they're either lying or doing something illegal. So we're not touting that we have some special gift, but what we do know is how to search for and be aware of the intrinsic value of investment opportunities. And we live and breathe it every single day. So we're always looking for buying opportunities. And, we might have something on our radar for a year before we make an investment because we're looking for much higher returns than a lot of investors are. So we're looking to purchase something that doesn't have a lot of risk to the downside and that other people may hate. And initially our investments, it may be a loss initially. In fact, most of the time when we buy something, we don't buy it at a bottom. Because early on, something that we had to learn is, as long-term value investors, you can't be greedy. There's no sense in timing tops or bottoms. And so I think
If something is an intrinsically good value today, it's still a good value.
right.
Even if we are looking for outsized returns, the kinds of companies that we're usually buying are companies that have gone through some sort of event. They're transitioning into a new business. They've had to move in and out of different markets, and the markets are pricing in risk over the next 6 months or so. So we oftentimes are looking through that because our time horizons are out more like 3 to 5 years.
But that's often a very difficult thing for most investors to do, is to make that decision to enter into something where it's not an immediate return. You may be
Right. Yeah.
And so a lot of contrarian investments may be a loser for a long time, or they may be flat for a long time. And then all of a sudden they way outperform.
So what I'm hearing is you guys, you're kind of leaning on the fact that you've been doing this since you were a kid. You've been doing it a really long time, and you're not looking at anything that's, not available to anybody else, but you kind of have been looking at this data and how to review an investment. It's secondhand to you. It's second nature. And so you're able to tell just by the data you're looking at, which ones have a long-term run.
I would agree with that.
And a lot of the data, there's a lot of the street are looking for different indicators than what we're looking for, because we are that long-term value hold. We're not looking for momentum. We're looking for, I'll give you an example. And I think this is a funny story, but there was a company, a jeweler, Signet Jewelers, you might be aware of.
I've heard of it.
Yeah. Yeah. And, way back, we see it pop up on the news, and the management.
You might have to censor yourself a little bit for this story.
Yeah. The management was having parties, and the company tanked. I mean, the
There were
management.
some activities that used a little money, money.
Yes. Some inappropriate activities were happening.
And, everybody was going to get fired. They thought
Purported, of
Right,
course.
right.
Yes.
And, there's a lot of funds that simply couldn't hold it for the press. I mean, everybody was selling it. It tanked. And so that's a buy sign for us. If the talking heads they hate it, we might take a look. And, we looked at the company, and they're doing fantastic. They have great financials. And the thing is, either the public is going to forget about it or management's going to change. Either way, the company is not going anywhere. Well, long story short, we bought that near bottom and made about 300% of the position. So
Wow.
that's the kind of buy we're looking for. But, it took a while for that appreciation because it was significant. I mean, the market's emotional. It's a very emotional response.
It probably took over a year. So let me ask you this. Are there any that you buy and they don't pan out, and does it matter because you're already buying low, right?
Oh, sure. That's a great point. Because we're one thing we have to be okay with as investors, especially contrarian investors, is making mistakes and being wrong. We have the ability to make a 180 and then a 360 and then another 180. And we're okay with that because to be a successful investor, you got to be right more than 50% of the time. And We're always looking for better opportunities than we currently have. And, if we have to take a loss, we have to take a loss. I mean, that's a very important part of a managed portfolio.
A huge part of our strategy is just the ability to be wrong faster because it allows us to redeploy resources.
Okay. And that's a big deal too. So moving into that, I think is how do you risk assess and risk mitigate the strategy overall? What are your tools and activities?
Depending on what you're comparing us to, we tend to be relatively risk off. We don't employ complicated option strategies. Although we do occasionally employ a short, it's the majority of the time that's going to be a very, very small portion of the portfolio.
But one of the great things about the contrarian philosophy is inherently you're buying things that everybody else already hates. And so there's not much room to the floor.
The sentiment's already negative enough that that's priced into this. There's a lot of downside that's already priced into the stock.
For example, when we were in a short, we're never shorting something we think is going to go bankrupt. We're just shorting something that we think is overvalued. And when we're buying a company, we're not buying something that is heavily in debt, no revenue, anything of that nature. I mean, we're buying companies with good financials, low debt, good management most of the time, but sometimes, as my previous example, you can overcome the management. But we're hopping on the earnings calls, asking questions,
Doing original research.
and so inherently, we're not going to buy something until it's in the depths of its valuation. Now,
So it's kind of hard to lose your shirt on any one investment. And the idea is you've got enough going that, like you said, maybe you're over half are going to make it up and out. It's going to.
We are diversified.
Yeah.
Right. Yeah.
And so it sounds like you guys do really care about diversification and making sure you're not over invested in any one company or investment type. It sounds like that's just inherently part of your strategy. Is that how it works?
It is.
and we it's interesting. We don't bet on we don't invest in macro political market trends, anything of that nature. We simply look for value wherever that may be. And so we don't necessarily concentrate in anything in particular. However, we can at times be concentrated in a certain sector simply because that's where the value is. And so historically, I mean, we weather the contrarian philosophy, weathers recessions very well. It's a lot of contrarian investors, for example, way outperformed after the dot-com bubble because you're in companies that are inherently not overvalued.
Interesting. And then obviously our investors care a lot about diversification and being able to be in investments that are different than the market, right? They're not going to trend the exact same ways. You guys that is what you do, right? You're like, yeah, we're deliberately looking to not trend with the market. So
now I do want to be clear. We're not like an inverse Kramer fund, right?
We get that a lot.
We're not just doing the opposite of whatever the market wants. Although sometimes people
from the conversation. Yeah, I wouldn't say that.
Sure. I just always like to clarify because sometimes people can take contrarian to mean, oh, we'll just do what the opposite of everybody. That's not what we do.
Right. You're looking for investments that the market is shy on, but that doesn't necessarily mean you're trying to do the exact opposite thing. Right.
Exactly.
Okay.
Yeah.
Okay. Yeah, I think it makes sense. And definitely a diversification option for those trying to not have everything in the market trend, right?
Right. Right.
Let's see. So I'll ask you this. At Carl, we pay a lot of attention to data and the digital transformation of investments. Has that impacted you guys? Obviously, you guys have been doing this for a long time, right? If you've been trained in this since you were a kid, have you seen the digital world and the digital transformation change how you work and what you're doing with your fund?
It certainly has. And, to the credit that we have been doing this a while, when we were trained, I mean, even as kids, our father used to show us smiley faces, frowny faces on the charts, technical analysis. And when Drew was a licensed broker, we used to write physical trade tickets, like paper.
At the
Physical
very
trade.
beginning. Yeah. I was trained I was trained before algorithmic training. I'm probably one of the last of a generation, where when I was trained, it was even kind of an older style of doing things. Um,
And this is actually to our benefit for this investment style. The the upward trend in what's been available with tech and news and information is always a benefit. I mean, we want as much information as possible. We have tons of information running all day. We absorb it, and determine what is important, what's not. And this availability of information has been great for retail investors and investors really understand what's going on. But it can be difficult with too much access to information.
Yeah, that's really the other side of this. Yep.
Right. And it can be difficult to determine what's important and what's not. And something that, we had to learn is there gets a point in derivative of information where it is too much. And there are a lot of indicators that that we're aware of, but that is too much information because the further you look at an investment, the more opportunities that you can find to say no. And the thing is, what we do is we take a risk, and sometimes we're wrong. But when we take a risk on something that's out of favor, there's heightened reward, right? And so we utilize a lot of programs to improve our workflow and access to information and give us as much as possible. But we have to filter that, right? Determine what's important.
I would say the closer we are to the investment, the better. We try not to put too many layers of derivative or rehashed information between us and the investment. Although we do watch it for market sentiment, I find that this is the reason we get on the calls and we read the actual earnings releases and parse that ourselves, is because if you rely on algorithmically generated news sources to get your opinions about companies, you're going to get a layer of disconnect between yourself and the investment.
Right. I think that's great. It's kind of refreshing to hear when someone is going all the way down into the core, or what I call the core data, as opposed to the static. You can get a lot of data about something, but the question is who created it, who envisioned it, right?
Well, you have to ask about that question even when it comes directly from the company too, because the company isn't always, they like to present things in a certain way.
Yes,
So
I
you
assume
have to be
most
careful.
of what I hear directly from a company is embellished if they are able to do so, right? It's just kind of how it works.
I will say my favorite kind of information to get from a company is that information which is very difficult to fit into normal checkboxes that are used for algorithmically generated news. Because what that'll often force is a misreporting of the situation because it doesn't quite mesh.
The models, right? But you
Right.
can take it separately and say, well, we still got this information and we should use it to make an assessment. Yeah.
Right.
Exactly.
And that goes, we invest in a lot of small cap companies at time that may not have a lot of coverage and they companies are not always the best at PR.
Yeah. It depends on the revenue, right?
Right. They might be really good at what they do, but their message to investors is often more difficult to read than it seems, especially when there's less coverage. And you have to understand that all these numbers come with context.
Right. Yeah. And it sounds like you guys have been through a lot of context, right? You've been through a lot of companies. They probably fit in buckets for you now. You're like, oh, this one's like, the purple kind. This one's the green kind.
Right.
Pretty much, yes.
Very exciting. You've been doing this a really long time. Do you have a final word on Woodworth for our interested investors?
We're long term. This is not for the sleight of heart that's looking for a quick buck. I mean, we take the management of our investors' capital very seriously. And we're looking to maximize long-term returns because, we're one of the investors as well. And the contrarian philosophy is core to what we do. It's adaptable. And so we
take a second look when other people count the stuff down and out, and sometimes that doesn't make us popular. Yeah, but it sure is nice. But it sure is nice getting the returns in the long run.
I was like, it makes you popular if you're the one getting the higher end returns. That's
Exactly.
kind of
Right.
how you've been successful. All right.
Oh.
Well, we thank you for taking a second look. It sounds like that has made all the difference for you. Thank you guys for coming on the show today. Really appreciate it. Thank you, all of our listeners. This is Woodworth, so we'll be coming up and be available within Carl. And we will see you next time. Bye-bye now.
Thanks for talking with you, Jamie.
Thank you for listening to the Invest with Carl podcast. The views shared on this podcast do not necessarily reflect the views of Carl. This podcast is intended for informational purposes only and is not intended to constitute and should not be deemed to be an offer to sell or a solicitation of an offer to buy any security or investment, financial advisory, legal, tax, accounting, or other professional advice. Carl funds are currently available to accredited investors with a minimum investment of $20,000. To learn more about Carl and to download the Carl app, go to investwithcarl.com.